I wanted to start investing.
Have you ever wondered why you should do it and how to go about it?
Are you also wondering who this other guy is? All will be revealed in today's video, all about investing. Stay tuned. Hello everyone and welcome back to my channel. I'm Stan and today we'll be talking about investing and some of the top tips you can follow in order to get yourself prepared for it and in order for you to do well in investing. Today's also a very special video because we've got our first guest of a very first collaboration on the channel, and the special guest, his name is Elliott. He's got his own channel, he's producing some great content, so do show your support and do show him some love. I'll put his channel in the description below. And without further ado, Elliott, he's been a very good friend of mine for years now. We went to university together, we're now producing content together, so I'll let him do his own introduction, but very happy to have you here and welcome to the channel, Elliott.
Hi, I'm Elliott. I run the channel in my own name, Elliott MacCallum, and I went to university with Stan, so we're friends from since then. Now, we both did automotive engineering at university, but we've since progressed onto careers in finance, and that's where our friendship has really grown. Now, unfortunately, my parents didn't give me a catchy name that rhymes with something cool, like Stan with a plan, so as I said, my channel name is just Elliott MacCallum, and I'm really hoping Stan's put my link in the description so you can subscribe and smash like buttons over there. So that's a quick intro to me, now let's get on with the content. So why should you start investing? Now, the key reason that I advocate for investing is the potential return that you can get. Now, of course, there are risks associated with investing, but the potential return is so much greater than the interest you can get in a bank account that over long periods of time, it has such a strong impact, and compound interest really is your friend. So one of the key things is that with index funds like the S&P 500, you can average a 9% return per year over a 30-year period. This is completely unmatched by any bank account up there. So for the moderate risk that you take when investing in an index fund like that, you should see quite good returns. Secondly, stocks have this advantage of this fantastic thing called dividends. So dividends are a share of the profits that a company makes, paid out to shareholders, essentially rewarding them for investing in the company. But when you buy dividend paying stocks, you not only get that passive payment of the dividends, but you also get a gain if the stock price increases. So it's basically a double whammy of income. And then finally, you should get investing because it's never been easier. You can access the market through free to use apps like Trading 212, Robinhood, eToro. All of these have really removed the barriers that prevented people from trading in the past and have reduced or removed the commissions on trades completely. But before you jump into things, here are some top tips from myself and Stan. So Stan, take it away.
Cheers, Elliott. Yes, top tips. So the very first one is you need to review your needs and goals and make yourself a plan. So what I mean by that is you really need to understand and decide what kind of investor you want to be, what kind of investments do you want to make. There's that whole dilemma between risk and reward, and that basically means if you want to go for something risky, you're kind of expecting a better return because you're risking that money, but also you kind of have to be prepared for losses as well. But if you're sticking with safe investments, you're kind of expecting sort of lower return because it's safer. It's kind of more certain is what I'm trying to say. So you need to decide, again, I think the best way to look at it is if you decide when you need the money and how long you want the investment to be. So are you looking to buy, say, a house in the next 5 years, or making a big purchase, say, in the next 5 years? Because with houses you can use your LISA, and we spoke about on this channel plenty. So if that's the case, then you probably want something safer because you need the money sooner. So with inflation and sort of the market going up and down, you probably want something safer to make sure that money grows a little bit, but so you don't lose any money. Whereas if you're, say, I don't know, building up a pension and you're looking at a long investment, say 30 years, then probably stocks will be the best thing for you because that will help you beat inflation and get a better return, a lot better return, as Elliott mentioned, than, say, your standard savings account. So just bear that in mind, and you really need to decide what kind of investor you want to be and how long the investment should be.
So the next key skill that we advocate for is to do your research. This is something that's really important if you're putting your own money on the line. You want to be confident that you understand where the company's going, or at least understand the financial metrics of the company and know that the company's going to be profitable in future. Because at the end of the day, when you're investing and becoming a shareholder, the company's profits become your profits. So you want to research as much as you can about the company and their direction that they're heading in the future and what the general market is looking towards. to make sure that you can be as confident as possible when making an investment. Now, you can find loads of information online for free. One of the easiest ways is to just use the brokerage that you're using. So Trading 212, Robinhood, eToro, pretty much all of them give a breakdown of the company's earnings per share and their price to earnings ratio. These are two really key metrics when deciding whether you should invest. But they also give loads of overviews and general information about the company, which you can use and leverage to decide on whether you want to invest. Now, if you're looking from a more technical standpoint, you can also look at platforms such as Simply Wall Street or TradingView. Both of these provide excellent breakdowns of different company metrics and different performance metrics that you can use to decide on whether to invest. So I suggest heading to either of those sites if you want to build your knowledge on what you need to know before you make an investment. Now the next thing, and I'm a big believer of this, is have a reason to be investing. Don't just buy shares because it's in the news or because someone else told you it'll be good. Do your own research and believe in what you're investing. Now it doesn't have to be that you necessarily believe in the company and think the company are going to be the best company in the world. But if you believe in the financials of the company or the numbers that you've produced which say that the share price will increase in future, then that can be enough of a belief to drive an investment. And finally, I'd say follow Warren Buffett's advice. Warren Buffett advised that you should treat investments as if you only have 20 investment choices to make over your entire lifetime. If you only had 20 companies you can invest in, think about how deliberate you'd be with the research you do and the choices you'd make. And I think you should apply that as keenly as you can and make sure that every investment decision you make is well researched. So there's no need to gamble or guess. Once you do the research and you understand the numbers and you understand where a company's prices might go, then you can start justifying your investments and seeing your returns grow.
Once you've done your research and you've bought your first stock, what you want to do is avoid trading overactivity and emotional decision making. And don't get me wrong, we're not saying sort of day trading is bad. We're not talking about that here. We're talking about investing, which is sort of long-term substantial growth. And what you want to do is you want to avoid looking at it every single day at your stocks, because that could lead to sort of overreacting. I mean, we're all a bit of a drama queen now and again. I mean, so am I, but what you don't want to do is see your stock, say, dip a little bit, go down, and you're thinking, oh no, what do I do? You start overreacting, thinking, do I sell, do I not? Just forget about it, let it do its thing, okay? Just leave it alone. So look at it, say once a month, plenty. That's absolutely plenty, because it'll sort of carry on growing, doing its own thing, you don't have to worry about it. And what I'm trying to say is basically, you wouldn't look at your pension every single day, would you? I mean, if you do, then tell me why.
Tell me why ain't nothing but a party.
Anyway, I know it can be difficult not to keep an eye on the scoreboard. I mean, I've been there myself. It's almost that buzz. So when you see your stock going up and up and up, you want to keep tabs on it every single day. But that's not what you want to do because of the opposite of that. So if they go down, you might be sort of prone to overreacting. And what you don't want to do is overreact over just some short-term events and focusing on the share price rather than the company value. So basically, all in all, just look at a stock, say once a month, and basically let it do its thing. And instead of reacting, what you could do is really look into it, sort of why the share price is changing. Is there something that's happening in the market? Is there a event, sort of like a one-off event, say, I don't know, the elections, which sort of happens once every 4 years? It just affects your stock, and then really after that won't really have an effect for the next 4 years. What's really happening to the stock? Is it something sort of internal? Is it something like underlying in the business? Really think about it. Is it something that's going to affect it short term or long term? And to basically carry on talking about stocks, I'm going to play you a quick clip from Warren Buffett, and here it is.
It's a temperamental quality, not an intellectual quality. You don't need tons of IQ in this business. You need a stable personality. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd. Because this is not a business where you take polls, it's a business where you think.
So that was just a very short clip from my mate, Warren Buffett. If you don't know who he is, basically look him up. If you don't know who he is, basically he's the CEO and the chairman of Berkshire Hathaway. Huge company, just look it up. He's got all the wisdom in the world and all the sort of money in the world as well. But he's basically a great role model for investors, because what he's explaining is you want to invest with your mind, not your gut. So what I mean is, think about what you're investing in and why you're investing in it. If you're seeking those sort of long-term, market-beating, wealth-building returns, then you don't want to invest with your emotions. Sort of leave them aside, don't get your emotions involved, sort of think about it, do it with your mind, do it with your head, and you'll be great.
Thanks, Dan. So another key point is that time in the market beats timing the market. So what this simply means is that don't just try and wait for the dip and then buy. What you should instead do is just aim to be in the market for a long time. Buy shares in different companies if you're investing long term, and just hold on to them and let them grow. Once you've done your research and you think the company is heading in a good direction, then buy shares and just let their value accumulate over time. You don't need to check the market every day. You don't need to constantly be jumping in and out of trades. And in fact, trying to time the market and trying to do these trades specifically could end up harming you in the long run. So there are some really easy strategies that you can employ to reduce your risk and the potential volatility of the market. So the first of these is dollar cost averaging. So dollar cost averaging is a really simple concept. You just set a set payment to buy shares at a certain time of every week, month, or quarter, and you just let it happen automatically. You don't adjust it, you don't have to put any thought into it, you just buy shares whether the price is high or low or the average. And what this does over time is create an average price for which you have bought the shares. And if you do this for a target company that you've researched, then that average price should aim to be lower than the price that you expect the price to rise to in future. So say the price fluctuates between $100 and $120 over a 6-month period, but you're buying in every month, then that means the average cost that you will have paid is $110. Now, if you've done your research and you believe the fair value of each share is actually $150, then when it rises to that, you will have made, on average, a $40 gain per share in that investment. So the next option you have is also to look at scaling into investments. So this is quite an interesting one. In this case, you set what you think is a fair value for the stock, and then you set a maximum price you're willing to pay for a share, which will be lower than that fair price because you're not going to buy it if it's higher than your fair price. Then what you do is anytime the stock reaches your maximum value or lower, you just buy extra shares in the company. What this does is reduce your average cost below your maximum share price that you'll buy into over time, which means that if the share price does rise like you expect, you're always going to see a return that's greater than the maximum share price you're willing to pay for anyway. So those are two of the key strategies that you can use to reduce your exposure to the volatility of the market.
So leading on from what Elliott just said, another way you could buy stocks is you could buy the basket. So buying the basket, if you can't decide which stocks to buy them all. So this takes the pressure off you picking the one, and it will allow you to basically pick a handful of various different stocks and different companies, because I think like that could be the easiest way. If you can't decide, sort of pick a few and sort of make a, I don't know, top 10, buy them all. Don't sort of think, oh, I want the one. Just buy many, why not? And that leads me on to actually a point where sort of why you should buy loads of companies is because of diversification. So you need to diversify your portfolio of stocks, and what that means is you want to own various companies, various industries, various markets, because you want to minimize the risk that your portfolio carries. So every stock will be volatile, so that means it'll go up and down, you don't know what will happen. And if you're picking, say, if most of your stocks are quite safe, so you've got like a nice sort of positive growth, and you're picking one stock or a bit risky, I want to make some money. If that stock suddenly goes down and you're losing a bit of money on that stock, sort of the money you're making from your other stocks will mean that your sort of overall performance is still on the up. It might be a bit less. Instead of saying, I don't know, making 10%, because of that one, you're now making 8%. But having different stocks will basically mean you're still earning that positive returns, and that's what you want at the end of the day. So basically buy a range of stocks and funds. And talking of funds, basically what I'm going to say is check out Elliott's video above. He goes into what sort of the various funds are, so like index funds, mutual funds, which ones you could buy, and the sort of advantages, disadvantages. So I'd highly recommend that video. So basically rounding off that point is diversify, buy various stocks to minimize the risk and to basically help yourself out, because you never know, that stock might boom suddenly. But that's it from from the tips point of view. What we want to talk about now very quickly is just touch upon some of the tips before you start investing. So the first one, I know we spoke about it a few weeks ago, but is that you want to have an emergency fund. And that's because you don't want to sort of risk all your money to start with. You want to build that safety net, that buffer, that if anything goes wrong, you lose your money sort of on stocks, because investing is risky. Just do bear that in mind. Do build yourself that 3 to 6 months emergency fund. So I've got a video on it as well, check it out on my channel. But build yourself an emergency fund so you have some money just in case.
So one of the key things that I want to highlight is don't get carried away with bandwagoning. Of course, it's fantastic to see things like GameStop rising 1,000% in a matter of weeks, or Bitcoin blasting through the roof and making millionaires from ordinary people. But the issue is that the number of people who get hurt by these investments is significantly greater than the number of people who profit from them. People who buy at the top of GameStop or Bitcoin lose life savings and lose so much money because they just jump into things because they see the news hyping it up, or their favourite Twitter personality puts out a post about it. So just be careful of when there's massive hype around a stock and it's growing exponentially quickly, because that can mean that a sharp crash is on the horizon. But overall, I'd say get started. There's nothing to stop you opening an account with a free to access broker like Trading 212 or eToro that allow you to use practice money to build up your trading skills before you even have to risk your own money. So get out there, give it a go and start learning. So thanks Stan for having me, thank you guys for watching, and now I'll hand over to Stan for his classic outro.
Thanks, Elliot. I appreciate that. And I appreciate you being here on this channel. This collaboration was very good fun. I think we should do it again. Let us know in the comments what you thought of the collaboration, or you want to see more of it, or you want to see something different. But thank you very much, Elliot, for being here. I mean, to you all watching, Elliott's producing some great content, like I mentioned. So do check out his channel. I'll put it in the link in the description below. And if whilst you're there, give him some love, give him a like, and why not subscribe while you're there? We've also done a video on his channel, more of a discussion kind of video. So I'll put that in I'll put the link for that in the description as well. But to all you watching, thank you very much for watching. I appreciate you being here as always. If you did enjoy the video, do consider liking, commenting, subscribing, and as always, save money, or invest in this case, so that one day that money can save you. I'll see you in the next video.